Okay, on a day when the cash rate was cut to a record low of 2%, and after Westpac disappointed the market yesterday, but ANZ pleased investors today, does this all breathe life into dividend-paying stocks? For his learned view on the subject, we have George Boubouras from Contango Asset Management, and as I said, joining us from Shanghai. Hi, George.
Peter, how are you?
Very good. I've got to say, you look miles better in Shanghai than you do in Melbourne.
It's the diet, Peter.
Okay, fair enough. Well, on the subject of diet, which is totally unrelated to what I'm going to ask you now, should we be on a diet of dividend-paying stocks if interest rates are still on the way down?
Well, yes, you should. And that's the demographic push as well in Australia. More people going into pension phase, more people potentially on the drawdown over the next decade. This is a long-term proposition. Dividend yields will feature in portfolios increasingly. The RBA obviously finally cut rates. However, in my mind, it hasn't changed. They need to go lower, and they need to stay lower for longer. I think they lost the narrative today by announcing it and leaving some confusion. The market, the Aussie dollar's up obviously, and the market's down for 0.5%. It was up 0.5% before. So I think a lot of people are confused about the perception of, is this the end of the cash rate easing cycle in Australia? I think it's not. To get those fiscal year 16 earnings to come through, cash rates need to head lower still. Aussie dollar must head lower, not higher like it did today. And CapEx expenditure must pick up for corporate Australia, and that's got to come from a budget initiative. So we're a long way from it, but they're good steps. But I think it's a confusing narrative that the RBA is displaying at the moment.
Okay, so to explain to the viewers, they've taken out of their statement that there's an easing bias. Is that what you're saying? And that is part of the reason why the Aus dollar went up?
Exactly. Not having a clear easing bias still. I don't know why they did not keep that in there, but they're quite clearly concerned about pockets of housing, obviously high density housing in parts of the East Coast are at record levels, and I understand that. First mortgage credit growth is okay, but not as robust as before, and home loan credit growth is not as robust as a prudential overlay. So what I'm trying to say is that they had an opportunity here to get the Aussie dollar lower, and in their narrative they've lost that opportunity. So people, particularly overseas, like investors here in the Northern Hemisphere, are looking at it saying, well, that's the final rate cut. Aussie dollar's high from here. So that was a missed opportunity, because you do need that lower Aussie dollar to help corporate Australia in general, and help our export markets, and to help the agricultural sector export to markets like China, for example, even more.
Okay, so it also means that unless they change their reference to an easing bias, then we're waiting for Janet Yellen and the Fed to start raising rates in the US to bring the Aus dollar down.
Spot on. And you know my view on that. I've always And a low and steady cash rate is a basic precondition as well. All those factors have to come into play. But yes, earnings are expected to grow. I'm still overweight the equity market, but that's the way I look at it.
Okay, so I'm searching for a silver lining in the slightly black cloud you've sent to Australia via Shanghai. Given what you said, and given that that the Reserve Bank might have to cut again, I was hoping they wouldn't have to, but listen to you, they might have to. If they do, and given what we're seeing in Europe, some small improvement over there, and given the fact that Yellen's not racing to raise interest rates in the USA, is it possible that this bull market is just going to be a slower, stretched out, longer bull market than the ones that we've been used to, which all of a sudden take off and then collapse in a hole? Is there a possibility that this is just going to be a longer, more drawn out, slower rising bull market?
Yeah, that's very much the core narrative. What you've gotten, not to oversimplify it, you've got global growth at sub-trend. Very uneven, you've got improvements in some pockets from very low base. But sub-trend global growth means stimulus is still coming. There's a lot of capacity that's yet to be utilised. Therefore, when stimulus is coming in your sub-trend growth, risk assets, equity markets, future earnings are priced high on a one-year view. That is the core narrative here, and that will persist. It won't be a booming equity market, but this weight of money is going to go somewhere. Half of European sovereigns are offering negative nominal yields.
Yeah.
Now, that just means you have to put the money somewhere else. And that's what they're doing. They're buying REITs, they're buying dividend income, they're going property assets, but equity markets globally are the ultimate inflation hedge, and equity markets globally are the beneficiaries of that outlook. It's just going to be a bit of a slower sort of view. But that dividend yield in Australia is still quite high versus offshore.
Yep. So when I saw Westpac yesterday at 35.40 or whatever it was, following the slightly disappointing report, my first question to my nearest and dearest colleague was, well, what's the yield on Westpac with franking credits? And it was still close to 7%. So are these banks are still a good buy, aren't they, even when they're not doing as well as we think?
They're a buy on the income, but you can't have both. They've got the limited upside of earnings to grow because that credit market rebound is nowhere near as strong. So you're there for the income, and for certain self-managed super funds, they're a great place to be on a 10-year, and you'll continue to buy it. Now, Westpac was a disappointing number, and if ANZ had reported yesterday and Westpac today, the banks wouldn't have sold off as much, in my view. While Westpac was a disappointing number, it is a yield play, but you can't have capital gain and capital growth. The credit binge of Australia from 1994 to 2007, that is over. It's more normalised credit markets, and it's very selective, but they are not growth stocks, they are income stocks, but they're highly geared income stocks because that's the nature of a banking exposure.
George, you seem to make even more sense from Shanghai. We might have to send you there in the future as well. Thanks for joining us, mate.
Well, yeah. So I'm here representing... No worries, cheerio.
Go, tell us who you're representing, George.
Well, the farmers of Australia. So we're up here... I mean, the opposition leader of the upper house of South Australia. David Ridgway, we're promoting lamb from the Clare Valley, Barossa Shiraz, Coffin Bay oysters. The agriculture sector of Australia is being promoted here, so it's a wonderful thing to do as well.
Yeah, without a doubt. A great product represented by one of the country's greatest farmers, George Boubouras. Thank you, George. Okay, after the break, we'll test out the proposition that the cut today will be the last.